Hello, friends, and welcome to the weekly talks with Quizzy Realty. I'm really happy to have the special guest today, and these two people, they are the loan originators with the company called Prefer Rates. And recently, I found there are a lot of questions regarding the financing or refinancing of the houses because the rates that went down, a lot of people were interested in doing so, but also at the same time they were not really familiar with the whole process and how it happens and the expenses and everything. So I decided that it would be a good chance for us to talk about this, the most common questions that I encounter, and so maybe you can guys clarify what actually happens and how the whole process works. So hopefully the people will be less confused about this whole thing of financing and refinancing if they want to do that. With that, I want to introduce my today's guests, Alicia Johnson and Saeed Sabah, and they will introduce themselves a little bit in more details. They'll talk about the company they work for. So please, guys, go ahead. The floor is all yours.
Thank you very much. My name is Saeed Sabah. This is Alicia Johnson. We've been a mortgage team for the better part of the last 10 years. Combined, we have about 35 years of experience. I have 20 and she has about 15 years of experience. So we've been at it at different levels and very different stages in the economy. And we wrote it out. It's just a passion that we have. We love the mortgage industry. That's why we're here today. And it's an honor again to be your guest. We work with a company called Preferred Rate Mortgage. It's a division of an even bigger company called American Pacific Mortgage, which is our group is out of Chicago. Our parent is out of Sacramento, California. And together we do about 30 billion in volume a year, all over the country. So we find that just being available and being high service, high touch for our clients is really the best policy. We don't pass off a task that we could do ourselves to somebody else just to make sure that we're handling it properly. So we found the high touch, smaller division within. We don't have a huge office. We keep it very, very family oriented, so we can control most situations. So we find it it's worked out better for us than having a huge staff. So
that's awesome, and I will provide the contact information at the end of this video so that people who are interested may contact you for more detailed information about the company and how you can help them. Yeah, sorry, Alicia, go ahead.
I was just going to say, for me, the biggest reward is helping people save money over time. That's huge for me. I mean, everybody has a family, everybody's struggling, and everybody has to save money. And if you can save money on your biggest investment, which is your house, that means a lot. You know, it helps people a lot. And that's my biggest goal when I go into a conversation with folks, either that are purchasing or refinancing at this time in our country, is to try to find ways for them to save incrementally over time for whatever asset that we're trying to finance. That's big to me, because I think those little bit of money that you're saving, you know, some people are saving like $200 and $300 and $400 and $500 a month, or they're changing their term from a 30 to a 15-year without changing their monthly payment. That's huge, because you're giving them something back that they can't ever give back. It's either money or time, and both of those things are so precious to everybody, especially young families, older families, whatever position you are in life. That speaks to people immensely. So that, for me, that's my number one reason for being in mortgage. I think it's just, if you're rich, you know, helping you maintain that wealth, or if you're just starting out, learning how to approach home purchase and home refinance, or, you know, especially families with children, that's huge. You know, I had one lady say that she might be able to provide better for her kids, you know, and with knowing that she's saving some money. And I think that means a lot, you know. So that's why I do it. And I think that's why he does it too.
A portion of it is very rewarding, especially the first-time home buyers in their homes. Doing a very complex refinance where you're saving thousands of dollars using the mortgage leverage dollars versus to help reposition their income position and debt level position. It's the same thing that major corporations do. We just do it at a smaller level for the American family.
Yeah.
So, it works the same way. It's nothing different than a reorganization within a company reshuffling billions of dollars without the use of bankruptcy. We're using the leverage and mortgage dollars in the economy to reposition their debt load so they can live better. And teaching new habits is also very rewarding to us. Trying to give somebody a plan, even if they have to take a higher rate now, and come back to me in a year and see that the plan has actually worked out, or 6 or 8 months, and see if it works itself out. And it usually has. If people can follow the plan, it's a home run for everybody. Myself, the people that we've instructed what to do, we find that is very enriching in our careers, and makes you able to look in the mirror at the end of the day and say, I did a great job. So we take it very personal. We take it, we have a deep passion about it. It's just, and sometimes, we're human beings. It gets the best of us, but we go out swinging every day for our clients. And that's really, our philosophy. Just staying involved throughout the whole process. We have a good relationship with our underwriters. We have about 40 underwriters at our disposal from our corporate, just our division alone. So we get high touches. We have direct, transparent communication with our underwriters. That means if there's a question or something doesn't make sense in a file, they know to reach out to us, and we know to give them a forewarning that, hey, you're going to see these documentations. Call me a little bit further if you need further description or elaboration of what they actually are and what they mean. So that makes it a lot easier to conduct business when somebody has an unusual situation, or an accountant made a mistake on something, but the client was really flying straight the way it was supposed to be done, and the accountant either skipped a step or just made a human error. They'll allow us to go back to the accountant and fix the error, and which allows the client to move forward with their refinance and financial needs within the mortgage tool. So, that makes it easier. You were nice enough to give me an outline to discuss what we offer today, and I have prepared the answers for you. I'm going to paraphrase the question so everybody hears the question out loud, and then I'll address the question. The first one.
Or maybe I'll just ask you, and then you answer the question.
Sure, that'd be fine. We'll do a talk show. We'll do a talk show style. That's perfect for us.
Yeah. So I just sent it ahead of time so that you guys would be prepared. So if you can tell me a little bit about the current market situation, and also how you actually adapt to this situation, or how people react to the current market situation, and then we'll go with the products that you offer to people. Okay.
We do find ourselves in the marketplace, an unprecedented event that's happened in all of our lifetimes. Nothing has happened during my almost 50 years of life, and I would assume yours and our audience today. But we're here in COVID-19, a pandemic that has hit worldwide economies and worldwide humans of the earth. I wish I could have phrased that better, but it's affected everybody in some way, somehow, and it has driven our mortgage rates to all-time lows. I thought during the Obama administration, when his administration climbed us out of the economy, climbed us out of the recession, in which we had depression-like economies from the 1920s during 2008 to about 2012, and it started finally recovering on its own, that mortgage rates are at all-time low. This has blown that away. We were offering low 3s at that time. Now we've been able to get some people in low 2s, but most of the rates we offer today are under 3%, which is unheard of, depending on the situation. So there's plenty of mortgage dollars available for the needs, even investor purchase money or investor refinance money. That is all being taken care of. I mean, it's offered today. But rates are at their all-time low. We don't know how long it's going to last, but I did see some headlines today that suggested, and it's little ones like Broadway is not going to start selling tickets again in New York City until May 31st of 2021, if that even happens again. That's a long closure for something that's detrimental to that economy. Little things like that suggest that the insiders know that this pandemic is going to last a lot longer than 12 or 15 months. It's going to go a couple of years. So we may not get back to what we thought was normal prior to this. We may be wearing masks for a long time. We may be watching out for our kids for a long time. We may be watching out where we go for a long time because nothing seemed to break it. And I don't think the election is going to make a determination of that. We're less than 30 days away, and that's not going to happen. It's just either we go with the status quo with our current president, or we elect a new one. It doesn't really matter. The pandemic's not going away, which means that the world financial markets are going to stay in a downturn until that happens. So we expect rates to remain low for the time being. And then
that doesn't mean that you wait until next year. If you can, like you were saying, Eldar, when we were looking at some other business, you should act upon it now while you can and capture the best rates that you can, because
it's immediate money savings.
It is immediate savings.
And it's long-term well-being. I mean, if you do it now or 6 months from now, the only difference is if you do it now, you know it's available. If you do it 6 months from now, it won't be available.
It may not be to the same extent. 3.125 on an investment property, 3.25 is amazing, and 2 3/4 for FHA primary. That's huge. I mean, so that is hitting so many young couples and so many people that are just starting their first purchase. They won't have to go and refinance later to a lower interest rate to save money. They're already in it from the very beginning, so you should start now while you know the interest rates are as low as we can get them. If you wait, we don't know to what extent, the interest rates are going to be low for. I mean, the new normal may be 3% instead of 2 3/4 or 2.875 or 2.625, and that changes your mortgage interest compounded, and you don't save as much. So it's good to start now if you can, right?
That's correct.
That's what I feel.
I agree, definitely. Yeah. So you want to be saving as early as possible, and that's what I also keep telling my clients too. Not saving only in terms of refinance, but saving and doing investments at your earliest convenience. When you feel actually that you have some additional money to invest, you have to start investing. The results you will see. The sooner you start investing, the sooner you'll see results. The same about the finance. It's also it's saving, but it's also investment, because you still have to pay something, but at the end you actually earn more. So
and people that are speculators in the stock market, you've seen great gains this year, but you've also seen some hard falls, depending on the timing. Just last week, we saw a 500-point drop because of stimulus talks. That wipes out billions in one day of people's money on paper. So, real estate doesn't take turns like that. It's a very slow decline. If it does go down, most of the time it goes up. We can talk about that a little bit more throughout the cast, but I wanted to add that last piece about the economy. Stock market's a roller coaster ride. We've seen people lose billions overnight. We've seen them gain it back the next day, but it's unstable. You just really got to make sure that your investments in the stock market are very, very steady, or you're hedged properly. So real estate's a different animal. Once you're in it, it's going to go up. You just have to be patient and ride it out.
I think real estate is the one true investment that you can make that will always seem to give you a return. So Eldar, I mean, you're smart to get involved in real estate as you are and move forward with that, because I mean, as you say, I mean, there's no way that we can get more land. I mean, God is not making more land. It's how you procure that land and what interest rate you get, and that includes home buying. And I can't stress enough how important it is to get involved as soon as you can possibly do so.
Yep, that's true. I completely agree with you guys. And the next question would be, what kind of products, what kind of loans do you actually offer? Because that's also important, and you can also explain why it's important too.
Sure. I'm going to break it down in two or three different segments versus product. Okay. For our purchase money transactions, those are people wanting to buy homes for either themselves to live in, homesteaded properties, and or investment properties. We'll offer conventional financing for first-time home buyers, as well as people that don't have a big down payment available. We offer products up to 97% loan to value using a conventional Freddie Mac and Fannie Mae both have a 97% product. If you're in the lower income threshold and you qualify for a first-time buyer, we'll have you do some homeowner education on your own, self-paced, takes about an hour. We'll also offer 3%, but what they will do, 3% down, that is, what they will do in that situation is they will give you the mortgage insurance rates as you're putting a 10% down payment. So, and that goes in factors. So the 97% loan to value factor is 35%. And that just means that the mortgage insurance rates are higher. When we do our first time home buyer conventional products, Home Ready and Home Possible, it's 25% MI factor. So it could save a couple $100 a month. And we do utilize those products from the conventional side quite often. A lot of people that are good savers would like to put 20% down on conventional loans. That allows the consumer not to have mortgage insurance in their payment or be required to have mortgage insurance. Mortgage insurance protects the bank only. It doesn't protect the consumer. So we do have other products that we piggyback on. For instance, if somebody has 10% they want to put down, but they don't want to escrow or they don't want to pay mortgage insurance, we can get them a second lien for another 10% if they're well qualified. And although the interest rate is higher on a second lien, the blended rate is still lower than what you would finance typically with mortgage insurance. So it ends up being a win-win. We're starting to utilize that more as property values have been going up, so people can't put as big a down payment down. The next part of our segment is the government lending. We do government lending, but government lending is specific to owner-occupied properties only. And we do FHA's full arsenal of products, 3.5% down. The reason we use FHA is it'll allow you to go up to 56.99% debt ratio. So if people are living tight, like most American families, we can squeeze their debt ratio in a lot easier, and they can tolerate it. And it also allows a lower down payment, so people that are paying rent today can still afford, in a lot of cases, to get 3.5% down. For the people that are well qualified, and when I say that, I say 640 FICO or higher, we can offer down payment assistance, a 3, 4, 5% grant, which is does not have to be paid back to the bank. And you can refinance. The rates are a little bit higher because you're using somebody else's money for free, but you don't have to pay it back, and you can refinance after you make your sixth payment if the rates are still favorable.
Well, then also on top of that, there's no commitment with anything being on title work or any.
What she's getting at is some municipalities will have a payback provision on their note where you have to pay it back if you refinance or sell the house or do not fail to own or occupy the house within 3 years, typically, or longer. So I've had to pay back. I've had to have people pay back their grants in some cases because of that. The product that we offer, which is specific to Texas, and we are licensed all over the country, but the Texas one is forgivable. It's fantastic. We like using it as a tool for folks, and it builds a customer for life. That's a benefit to us. So we love that. Our veterans, we protect them. We do 100% zero down VA loans. We can also stretch the debt ratio.
Eldar, if you like, your listeners, this is a lot to hear, and they really just need to know what's going to be important to them. They can either give us a call, or we could put something together that would give them a little bit of information if you need to, either way, to try to help out, maybe like a little informational flyer to go along with it, because it's a lot of information to ingest in a short period of time. But the main thing is there is a product for every person out there, unless your credit score is in the 400s. And if that happens, then we just need to work on trying to get your credit score up and advising you what to do.
They'll work
there.
on better credit habits. And,
We'll help you with that too. So that's.
Then we have, but then we also offer USDA products. Those are 0% down. There's a lot of provisions that go with that. It's not a very popular product, but if the home is rural and it qualifies for it, it is something that can be offered. It's a little bit more of an expensive loan in the long run. That's why it's not as popular, but they're available to the right person. So, you know.
Everybody gets low interest rates. The down payment is minimal. We can support it with down payment assistance if a customer needs it and move forward. The only pitfall with an FHA loan is if two people are married and one person is going to be on the loan and the other one isn't. Let's say we have a married couple and one's married and one, I mean, they're married, one's working and one isn't working. We have to add the debts of both people onto the debt load. So that's the only fallback I see with FHA. But most of, let's say our clients, me and you, Eldar, will fit into the FHA bucket, and we close them beautifully. They get the lower interest rate and the lower down payment. I think that's mostly where our audience would be looking at this point. So.
And then 2 more segments on purchase. We offer jumbo loans through the major banks, Wells Fargo, Chase, US Bank, a couple different credit unions. As little, we have one that will do 10% down. It's a little bit higher rate because they finance the mortgage insurance into the rate. So somebody that would normally qualify for a good old jumbo loan at 3.5% will probably pay 4.25% because they're putting a lower down payment down. So it's a little bit more expensive, but it's a way to get into a jumbo, and that's anything, and that's defined today in Texas as anything over 510 400 would be in jumbo. Any loan amount over 510 400 would be considered jumbo today. That may change in January. Our conventional loan limits have gone up the last 2 years after being stuck at 417 for a long time. So for 20 years plus.
Tell them what the FHA one is as far as the county loan limit for Harris County and Fort Bend.
I believe FHA in Harris County and Fort Bend can go up to 331,900 or something like that. It's different. If some of your viewers in Austin has a higher limit. If some of your viewers are in Dallas has a higher limit. We just have to investigate it per county when we come across that situation. More of the rural counties are going to be more like 297 to 330. So for some reason, the Houston Metroplex has not risen like the rest of the bigger states, or bigger cities in our state, which Houston is number fourth biggest city in the United States, you'd think. But they go by per capita and household income. So it's, for some reason, Houston didn't make the cut last time when they raised it. So we're hoping, because we're seeing the prices in Houston rise from a real estate perspective, and FHA would be a good tool for a lot of people there. So, because the first-time home buyer is paying near 300 now versus 200, not more than 3 or 4 years ago. The average price has changed quite a bit.
No, definitely. There's some appreciation being going on in Houston for the last what I observed.
We've had almost negative inventory for years. You have about you guys run at about 30 days or less of inventory at any given time. So I mean, even appraisers are tight. We can talk about that on a miscellaneous thing, but that part's tight. The other thing we offer is we have non-qualified mortgage. And what does that mean? It means that you can't qualify with your normal career. If you're a self-employed person, we would use 2 years tax returns to qualify typically. With the advantages and the tax breaks that are big in the political spectrum today, people that have taken advantage of those often don't qualify for conventional or FHA mortgages or any kind of mortgage because taking advantage of the tax breaks. They're not broke people. We verify it a different way. And the ways we verify it is 12 to 24 months of bank statements using cash flow, using a reasonable margin or ratio for expense ratio, that kind of thing. So that tends to change, but we do have access to that. The downfall of those products, it's usually a bigger down payment commitment, 10 to 15% or bigger. and it's also a higher rate because they're grading you on risk, not price. So
You also have to have a family.
you have to have, you have to be pretty responsible everywhere else. You got to have a good FICO score. You got to show that you pay your bills with what you show on paper, which isn't good. You know, there's some factors to that, but it does allow people to get in the homes. I mean, and the rates are typically between 6 and 9%, depending on where you fall.
You can also utilize that with foreign national programs as well. That's another segue. I don't know how many folks that you service that might be foreign national, meaning
I-10 numbers versus socials, that kind of thing. So
citizens of another country that come over, you know, on an H1.
And Houston's a huge melting pot. I mean, there's a lot of international business that transpires in Houston. So
we can offer that as well.
That's good to know, because I also received a lot of questions from people who came or on different visa types, and they asking this question all the time: can we finance our purchase of real estate property here in particularly in Houston or in any other areas of Texas? So this is a good question. So the topic, but I think it will be better if I just send those people towards you and you can explain a little bit more in detail.
The natural situation on that is everybody's situation is going to be a little bit different. How they conduct their financial planning, how what their tax strategy is versus everything else. So, you know, that part happens. So we have to tailor everybody differently when we talk to them. We have to understand their story. We got to get to the bottom of it. We ask the comfortable and uncomfortable questions so we can understand the full story with no judgment. Things happen. Things happen to great people, and hey, we're here to facilitate somebody's needs and dreams wherever we can. So that part's not an issue. The last part of the product spectrum I'll cover is just the opposite. We can do refinances also in all those product spectrums. Conventional offers refinances on investment properties up to 80%. We can purchase investment properties down to 50% down. So they're a little bit more conservative on the refinance side, but we can do that. And then on FHA, there's a couple different ways you can refinance. You can do a streamlined refinance as long as your scores are at minimum levels. And that means that we don't require income proof again. So you're one and done, and you can still take advantage. I'm going to write. And then VA is even easier. We just have to prove benefit, and we go off the old findings of the veteran loan. So it's
interest rates for full streamline are amazing.
Yeah, I mean, they've been under 3 all year. And then as people's situations, we can always research other products. One of the advantages of and one of the drivers to come to this company this year was their wide range of product spectrum. They felt like you're always going to get questions for products. You're always going, why don't we have them all available? And honestly, at any given time, we always do, except COVID has slowed down some product offerings. Like renovation loans are out right now because of all the constant contact that the homeowner has to have of contractors and people coming in and out. They deemed it unsafe, so they've frozen those loans right now. Those will be back. Those are big. And we do conventional loans and FHA loans for full renovation when that product's available. Second liens, we do have some suitors right now. That hasn't dried up. We're doing great with that. And they're relatively easy to get done. They piggyback off the first lien. So our first lien underwriter does most of the heavy lifting and underwriting, and they piggyback off it. They go off our income calcs, our desktop underwriting findings, our loan to values, our appraisal, our title work, our title company that we've chosen to serve the customer under. All that falls into place in the second lien company. So it's
that's handy if you have a demo. I'm doing a lot of refinances where someone is in a jumbo loan, which is over the 510. So very simply, instead of refinancing with a higher interest rate, because jumbos usually have the higher interest rate, we'll break it down. Let's say someone has a $600,000 loan balance. We'll break it down and do the 510, 400 on a regular conventional, less with the lower interest rate. And then the rest of it we'll put on a second lien with a little bit higher, but that blended rate is still lower. If you take blended rate, meaning you take the interest rate from
You take a weighted average of the paper. So for instance, if you had a $750,000 mortgage, oops, sorry, I'm just trying to do a quick example. 510, 400. So let's say you had a $750,000, you needed to cover $750,000 in mortgage dollars. We would take a first at 510, 400. That's 68%. That rate would typically be 2.75 right now. I'm just quoting yesterday's rates.
Yeah.
Great weighted average. So 68% of your money is going to be at 2.75. The other 32% will be at 6%. But the blended average on that's going to be about 3.25 on all your paper.
which is still better.
So if you're in the fours right now, you've just improved your paper by 75 basis points minimum. 125, you're 4.5. It's a home run still for you. And you don't have to escrow if you don't want to. There's no mortgage insurance. And there's no prepayment penalty on either of the paper. So you can double up on the second liens because it's a little bit higher. Keep paying the first lien until you get to that lien is paid off. That's released. You're sitting at a 68% or lower loan to value picture within a few years. So it makes a huge difference.
The important thing for you with that is anytime you're getting the lower interest rate means that you're saving mortgage interest over time. So you're acquiring this house at a lower interest rate, so you're paying back for the same asset. And that's the reason why you would always want to look to refinancing at a lower interest rate, because you're paying less money over time for the same house, same asset, paying less. And that's huge. I think that's the biggest part for me that makes the biggest difference. So if you get anything out of it, I mean, some of this stuff is going to be over your average person's head, but I mean, that's the key piece to remember there.
Yeah. And we can do that. We can do that same blended average rate if somebody wants to pay off an enormous amount of debt using the equity in their house. We can take their credit card statements and weigh what equity they're paying off at their 20 or 30% rates versus a 2.75 or even a little bit higher mortgage rate, because cash out loans are a little bit higher in rate. Probably call it 3.25. We can take their 20% at $100,000 of debt, and 80%, and there's at 2.75, and show them that their blended rate's probably in the fours overall on all their paper. It makes sense. We can show where it makes sense, and we'll use that as a litmus test to make sure we're serving the customer the right way.
I do that on every deal on a refinance.
Okay. Those are people that want to do like cash out and pay off debt specifically because they've gotten themselves into a jam or they've just been carrying too much debt in their household. I mean, we work with that angle as well, but we'll get more scientific and granular with it if need be. So it just depends on what the client wants to understand. And but that's basically, we have just about every product that is out there for every type of situation. Some are limited right now, and some have increased their standards a bit because of COVID, and they didn't want to take out as much risk. But typically, there's nothing that we can't offer. We even have a commercial loan division for people that have commercial action that they need handled. So, and we also partner with insurance companies to get you guys the best rate. We don't get paid off insurance. We don't care who you use, but we do like qualified insurance agents to help serve our customers and give them a perspective. And we do hold them to standards. Make sure you're educating them. Make sure they understand what it's covering. Make sure
Well, that lowers the fixed expenses. Maybe on a different podcast, it would be nice to kind of explain, what makes up a mortgage payment. The 4 components that make up the mortgage payment. So you can understand how each expense is really important to make sure that we put all of those pieces together to get the end product, not only get mortgage payment with the lowest interest rate, but also get those fixed expenses that go into the mortgage payment at the lowest possible cost. And then also make sure that your homeowners, not your homeowner's insurance, your real estate taxes are figured with that homestead exemption on it, and that you're getting all your possible exemptions as well. I know that's for future.
A lot of first-time home buyers don't think to file their exemptions.
Good things.
We make them do it at the time of closing often.
We try. So, yeah, that's good.
Okay, that's great. I guess the next question I received a lot is, what would be the major difference in terms of the requirements and documents for people with W-2 versus 1099?
That's a great question, and it's real simple. People that are W-2 outside of true 1065 or 1120S partnerships are employed. They're employed by somebody. They're being paid a set amount of wages that they've negotiated or they've earned for doing the job that they do today. And that's considered employed. We take the gross income and anything that they are entitled to, overtime, bonus, spiffs, allowances, car allowance, phone allowance, per diems, and we use that at true value, undiscounted. And that's how we calculate their income.
It's a gross.
Everything's gross, non-taxed. And then 1099 employees are typically self-employed individuals that perform jobs and file either a Schedule C or they're paid, I'll add to it, 1099/K1. They're paid a K1 for their duties to their own corporation. And those are self-employed people. We always have to have a 2-year work history no matter what the client does for a living. If they're employed or self-employed or a combination of both. We always have to cover 2 years. Same with residence history. But the self-employment people, we almost always have to use a 2-year average. They've been lightening up a little bit. If the client has a good FICO score, the LTV is reasonable, we can typically go with a 1-year average if they've been self-employed for over 5 years. There's some provisions in our automated underwriting system that have gotten a little bit lighter, but it has to be like reserves, some money in the bank. It has to be, a 720 plus FICO score, and then usually the loan to value needs to be between 60 and 85. Usually the higher loan to values do not receive the same love on that. So it's great for people that had a great year in 19 versus 18. So we can sort of exclude the 18 average and go with the 19 average only. And that it's a game changer in a lot of cases. Now, the nice thing about W-2 right now, with the exception of FHA, if we're doing conventional W-2, we can just get a written verification of employment either through a third-party automated system like the work number, or any subscription service that employers use today, or we can have their HR fill it out. And then we can eliminate the need for pay stubs and W-2s. Conventional will accept just the written verification of employment.
But I always like to get the W-2s, 2 years of W-2s and 30 days worth of paycheck stubs, just to verify that we are pushing the right documentation to the underwriter. So it's always best as a standard when you're a new home buyer or even a refinance to send the 2 years of W-2s and 30 days worth of paychecks.
And there's some exceptions to that. If the work number matches everything that we have, we just throw the pay stubs and the W-2s in the garbage. If they don't, or we shred them really, we don't throw anything in the garbage. But if it doesn't match, we'll use the W-2s and pay stubs to support that the automated income system is not accurate. It's human driven, so if their books aren't always up to date, it delays. So somebody might miss a big bonus. Great, you got a bonus? Show me the bonus check. Okay. We'll go back and get a manual written verification of employment from your employer showing that money in lieu of the work number situation. So it just depends on the customer. But let's say somebody works for Shell. They're going to be on the work number. Should be really easy, automated. We pull it. That's the only income documentation we'll need from them. I mean, it's real simple. So it just depends. So it's come a lot. It's getting a little bit looser for some clients and a little bit harder on others. It just depends on the situation. And then, so basically reiterate, W-2s, you're employed, 1099/K1s, you work for yourself doing your craft. And anybody, I mean, you can be self-employed doing anything. It just depends on what your passion is and what you made a career for yourself out of. Realtors are self-employed typically.
Yes, and I know that's for sure. Another question is about the expenses. So the people who refinanced the houses, or even the first-time home buyers, they sometimes get really overwhelmed and confused about the expenses that they see on the closing disclosures. And so a lot of times I saw several chats where people actually discuss, are those expenses legit? Is there something they can do about them? Can they discuss those expenses and maybe reduce them? And also the wording on some of them is a little bit confusing in terms of, like, you see the ones that you can shop for. And so the people say, I never shop for those expenses. So what does this really mean?
Okay, great question. And I'll go back with a little bit of a history lesson first. Prior to 2015, we used to offer two documents. One would be your good old-fashioned good faith estimate, where the loan originator was responsible for researching what the cost of mortgage is for that customer situation, really the program or their FICO score, or et cetera. So our regulators, the CFPB, came in and they created a one disclosure for the time of initial application, which is called a loan estimate. And then it holds the good part of it is it holds the lenders accountable to being within 10% tolerance of all the fees that they put on there. So typically you'll see your loan estimates a bit higher than your closing disclosure. And because the lenders are covering their basis, because they're held accountable to a tolerance that is not, it's not excusable in any case. You have to be relative.
Can you tell them the requirement as far as when you have to disclose?
Yeah. So long story short, based on the initial disclosure, it has to be within 3 days of your application. So an application is defined as a credit pull, an address for a refinance, and or a purchase contract for a purchase. We have to disclose within 3 business days. So we need to gather up all the fees and put what the cost of finance is going to be. And that can be the appraisal fee. That can be the third-party title fees. If the contractor is calling for a survey, we'd have to put the survey fee in there, and we have to differentiate who's paying what, so the consumer knows. So sometimes the number's scary because the loan estimate is all costs associated with the transaction, regardless of who's paying them. So the consumer that's receiving, the consumer is the only one, our purchaser, our person refinancing is the only one that's receiving that document. The seller receives their document from the title company. It has nothing to do with us. But some of the things on that estimate, the seller is responsible for. But when the consumer looks at it, they look at the grand total, they're like, this is going to cost me 20 grand? No, not all the time. It's going to cost you your portion of what expenses you contractually agreed to. So to break down the sections, what you can shop for, what you can't. Obviously, you can shop for a lender. There's no gun holding to your head. I mean, we're aiming to please everybody, but we have our fees and margins, and we have to make a reasonable amount of money on each file to make it worth our while to spend the time and energy. So, yeah, I mean, of course, I mean, it's the same with any business. Yeah, but so we have our origination fees, which are typically just processing and underwriting. We don't charge any points or a percentage of anything. It's just a flat fee. And then there's usually a credit report fee, which is usually $34 to $59, depending on if it's a single or joint. A flood cert fee, which is we don't profit on that. They cost $25. We charge $25, and that's most lenders. There's no advantage to charging an extra $10 for a flood fee. It's just, that's not where your money is. And then the appraisal fee. Market appraisals have gone through the roof because there's a shortage of appraisers, and they're taking an astronomical amount of time. What used to take less than a week are taking 2 to 3 weeks now. So it's very frustrating. It's very, and our vendors have a hard time. They'll have guys that'll accept the order, and then they'll drag on, and then they'll cancel the last minute. They have to go find another one, and you have to give them there a lot of time. It's a nightmare, but it's part of the business right now. We've got to deal with it. And then there's the fees that you can shop for. Assuming that the mortgage is out of the question, you pick the lender, that's us or somebody else, it's not negotiable really. Then you have your third-party fees. Your third-party fees are going to be the appraiser once again. It's going to be the title company. Title company, and this is where people think, if I just go to this title company, that title company. The good news is all the title insurance and endorsement fees that you see on there that are required by the state are state mandated by the Texas Department of Insurance. So those aren't negotiable because they're published statewide rates that all title companies have to adhere to.
But they're based off of your loan amount. So, Eldar, let's say you were doing a refinance and you had one specific property. If I went to one title company, the title insurance is gonna be the same amount as if I went to a different company because your loan balance is the same. So you're not getting messed around with your title company because it's mandated. So that really helps out some.
There's a couple fees on the title that the title company charges that is discretionary to them. They have to be within reason or within tolerance of everybody else, but it's their escrow fee, which is also known as a closing fee or settlement fee.
And that's usually between $350 to $500, depending on which title company we work with and which one is preferred, maybe on a purchase contract. So that's, that's marginal savings versus $150. It's really not.
Some title companies charge an extra doc prep fee or courier fee. Those are all those are all tolerated fees. They're all part of normal business, but those are discretionary what they actually charge. You will find, because you can't favor one individual over another with your fee, you can't say, okay, well, I really like Eldar, I'm gonna give him a $300 closing fee versus the $475 I charge everybody else. That would be unfair treatment. So they have to, most of the time, they have to stick to their guns. I had a refinance in California, or a purchase in California, and the guy wanted to argue about every fee, and I'm like, these are the same fees they charge everybody. They just can't give you a break because you're arguing. They have to stay the same. So, that's one of the things. The recording fee, that's set by every county. So depending on the number of pages sent to the clerk's office, that's what they charge, dollar for dollar. It's not a fee that you can upcharge. It's just not. It's not normal. So we typically will disclose 210, and then it usually falls around 137 to 150. But we know we're going to mark that down as soon as we get the real number from the title company. We just don't know from county to county which one. So we have to inflate it for a second, but it always comes down to true dollar what is charged. Same with, if we're going to estimate $600 for appraisal, it comes in at $550. Of course, we're going to lower on the final CD it back down to real price, $550. We don't own the appraiser. They're not lining our pockets. They're third-party providers. So that is, so whatever they charge, we put it true to the dollar. Same with the surveyor or any other third-party service, like a pest inspection or a well inspection if the house is rural. It's not our margin. It's not our business. We just publish what the estimated is when we disclose it, and then we come back and make it true life, whatever whatever the cost actually had to be.
So, Eldar, before we go on to the next subject, I'm just going to just say one thing. We have a lot of folks, and you may in your audience as well have a lot of folks that are purchasing a new home build. I want to stress to you, it's very important, even though a new home builder usually has a preferred lender that they like to work with, and that preferred lender will usually offer some added benefit to the customer as an advantage of using them. That way the builder can keep the relationship very tight and know, how things are going through very quickly since they're affiliated. I will tell you that I've run into many situations, and I have one I have to talk to right after we get off the phone here, that where a new home builder will offer incentives, but as much as they're offering incentives, they are charging the customer extra fees, or they're charging more for the same type of services. Like, for instance, we got an estimate for a customer buying a $250,000 house. Well, the lender is going to give them a 3 3/4 rate, which by all standards right now, 2 3/4 is what most lenders are offering that would not be affiliated with this builder. So even though the customer is getting, marked fees taken off of their closing, they're having to take a higher rate to get that. And I would like to caution your audience that even though, especially ones that are going to a new home builder, to definitely shop around with their lender that they like, a friend, a family member, whoever refers you, us if you like, to really take a look at what your preferred lender is offering versus what they can actually get, because sometimes it's not an advantage to go with your new home builder's lender, just because they'll say, okay, I'm going to give you $5,000 to your closing, but then they'll stack their lender fees and such higher to where they're just paying themselves back, and the customer, it's kind of like a abracadabra situation where it looks like
you see the fees and the extra fees added where they can. They actually pad their margins with junk fees to offset to really pay back the builder for the concession. It doesn't make any sense sometimes.
It was a shame. I actually have to talk to this customer as soon as we get off this podcast, and he's confused. It confuses folks where they think that they're getting something. They may be getting something, but then the lender's taking it back completely by charging more. And so I think it's predatory in a way, but that's a different discussion.
Totally legal though.
It is totally legal, but it's like, you, as a consumer, you need to know all of the best ways to go about it.
Because you're accepting their service for the concession at the end of the day. So it's a total enticement, but it's a legal enticement.
But you wouldn't, Eldar, as a realtor, you would not want that happening to your clientele. And if the only way to really make sure and safeguard against that is to encourage, go out there and look at different lenders and talk to some other professionals and really make a judgment and chart it out before you make a final decision on your lender. It's really important to do that. That's so huge.
Yeah, no, you're totally correct. And I always encourage my clients to go and shop for pretty much anything they do. So it's a very important point. We have probably less than 10 minutes left. I don't want to take too much time of your and we're probably just going to jump to very quick. If you can summarize, you mentioned briefly before that the time of the closing takes longer because of the availability of appraisers. For example, what is the timeline right now we're looking at so that people can understand how much it's actually going to take for them to get the finance or do the refinance?
We can complete most deals within 30 days. Because we cover everything else and cover all the issues, all the income, all the verifications while we're waiting for the appraisal. So the appraisal is typically the last thing that we need in a transaction.
But it's always good if you're doing a refinance, to make sure and give yourself 45 days and to always make your payments, all right, until your loan closes, to safeguard your credit. It's not good when you're doing a refinance with any lender to think, okay, well, the lender's going to get it completed by the end of the month, so I don't have to make my payment. It's always good to protect your credit, because a late pay, a 30-day late on your credit goes against your refinance and would definitely change things for anybody refinancing. So it's always best to allow the lender 45 days. 30 days is our average, but 45 days just in case something comes up. So
now, all purchases are always going to need an appraisal. I'd say 99% of the time. The only time where I've ever seen it waived is if somebody was putting 40 or 50% down on the property, and then the reason it was waived is I got a property inspection waiver from the automated underwriting system. And what that is Fannie Mae and Freddie Mac, the two providers of conventional loans, to provide liquidity to the secondary market, and we follow their guidelines, have a database of all the properties that have been appraised probably in the last 5 years. We send us a digital copy to them every time we do an appraisal. So they keep a database of millions and millions of properties. So there's a good chance I wouldn't say every property in the United States is in there, but I'd say probably 70% are in their database. On refinances, if we match up to what it appraised for last time, or really look at the tax value versus, and then really hone in on what it appraised for, we can often get that property inspection waiver waived. When that's the case, we can usually get a deal done, a refinance done within 3 weeks. God willing and customer cooperative everything we ask for. Send me your mortgage statement, send me this, send me this. We can usually get those done relatively quickly. On government loans, on refinances, if we're just doing an FHA streamline or a VA streamline, the loan to value is irrelevant. It doesn't matter. We do not need an appraisal. It's mostly the purchase stuff. So what I was going back before Alicia had made her point, which was a great point, was we order the appraisal the minute they sign their documents on a purchase, so it gets the ball rolling. During that time period, we're solving for their verifications. We're solving for their insurance quote. We're solving for whatever needs to be addressed on their credit report or financial statements. And we need a letter from the CPA. We're getting all that stuff done while the appraisal is taking its time. And we're getting the file underwritten. So one of the last few conditions we always need on a purchase money transaction is the actual appraisal and the compliance documents that go along with that. So we keep it under 30 days in most cases on that. The days of doing a 3-week purchase and 2-week purchase with an appraisal are gone right now. As the refinances dry up a little bit, that will allow more the appraisals will be able to turn the files faster.
Honestly, so, I don't see where refinances are going to be trying to.
Now, one thing, I know we're skipping a couple of your outline questions. I want to tell you, Fannie Mae and Freddie Mac are trying to slow down the refinance pipeline because it's overwhelming. They're raising their rates by 50 basis points. Not rates, but cost of finance by 50 basis points. Starting October 15th. Because lenders, if they deliver past December 1st, we have to lock before October 15th to preserve those for consumers. So it's very important, and it's all lenders. It's not just us. It's not a gimmick to get people in the door in the next 3 days. Because honestly, I could probably take on 3 customers, and my plate's full. I don't know what Alicia's got on her plate, but we're getting everybody that has asked for a refinance now locked by the 15th.
Because the advantages are so great that it's totally worth it. If you'll talk to me, then
they tried to do it in August with no notice, and all the lenders pushed back and said, "Hey, you're not being fair about this." They said, "Okay, we'll give you 90 days, 120 days to get your pipelines in order." And come December 1st, that tax will be on there. And that also, I also wanted to, you asked about how rates and everything. Rates on conventional loans are 90% FICO and loan to value. That's it. That's all that's where they put their risk premiums in. If you're 740 and above, your mortgage insurance is going to be cheaper. Your interest rates, you're totally above the bell curve. Everything's going to be cheaper across the board. Lower par rates, everything. If you're that 680 to 720, it's still respectable. The world's going to tell you have good credit. You can walk in everywhere. You can buy a car. You can get a credit card. You can go to a department store, whatever you need. But that's below average. 720 and above, yeah. But you're still our customer. We still love you. It's just the rates aren't going to be as good. On FHA doesn't care. As long as you're above their minimum score, they're going to offer lower rates. Same with VA. So it's not so FICO specific.
That's why I love FHA. I have a single mom. She's never had anything in her life. We used down payments, got her into a house, and she got a really good rate. And that's like pennies from heaven, that's just wonderful things that can happen for people. And that's the reason why I advocate.
And what I forgot to say on the closing cost is purchase money closing costs are typically more expensive than refinance closing costs. And the reason being is there's a cost to recoup for benefit on a refinance. And there's not a 100% need for a full-blown title to policy. Again, we just offer a lender's title policy, and you're getting a rebate off your purchase one within the 7 years. So you get a reissue rate versus a full rate on your title policy. And then we have to make sure there's a litmus test that you can recoup your funds within the difference in cost within 24 months, typically. 12 months is more realistic, and we try to keep it under that. So there's generally different incentives on those to bring them in the door because it's cheaper. So this time of year, it's expensive because of prepaids. All our taxes are due starting October 1st in Texas to be delivered by December 1st, late by February. So people that are escrowed and they want to continue to escrow, we have to refund their escrow accounts. They get the money back. So it's great for people wanting extra cash during the holidays. and they have the equity for it, we can start a new escrow account for them, pay their taxes when they're due, and then they can get the money back from their current servicer. So it ends up being helpful if they need to free up some cash flow this time.
Oh, yeah, we should probably do more podcasts, drawing deep into the different wells. So purchase, like a whole segment on purchase, a whole segment on refinance. That way, all these specifics that Saeed is giving you, we can put them into more of a practical use for folks that would be more educational maybe. So if you're open to that, we would be willing to do something like that.
That's a good point. I was just thinking about it. I was thinking to put this video out there and get some feedback and see what actually people are interested to hear. There's probably going to be tons of other questions, and so maybe in the later time, in a few weeks, we may meet again and discuss those questions, and that would be great too. And for today, I would like to thank you guys for this discussion, for spending the last 30, 40 minutes with us. It was really great, very informative. I think I would have to watch this video several times to understand, really, to get all the points that we covered. But I hope the audience enjoyed it too. Please follow me on Instagram and Facebook, and the contacts of Alicia and Saeed will be included in this video. So we'll stay in touch.
Anything you didn't understand, feel free to contact us, and we'll
It's a lot of information, okay?
over a short period of time. Yeah.
That's why I was like, there are some things that are going to fit some people and some things that aren't. And the only way to truly know how it's going to fit your situation is to, hopefully we'll have more podcasts, but then also to get in touch with your lenders. I mean, us, if you like, or any of your other lenders out there, and just really have it drilled down specifically to your needs. And that's what we're all here to do, is help out like that. So
this is awesome. Thank you much. Thank you very much, guys, and enjoy the rest of today. And we'll talk to you next week or in a few weeks.
Good. Thanks for having us. We're at your disposal for anything you guys need. Thank you.
Always.
All right. Bye.
Even if it's just questions.
It's just fine.